I'm Cathy Yang, your intel on the Philippine markets and the economy. In the headlines, Philippine employment for November has come in at 95.6%. Consul Nina Manju, the immediate past president of PCCI and chairman emeritus of the Employers Confederation of the Philippines, joins us live. Bangko Sentral Governor Eli Remolona says a February rate cut is on the table following below-target inflation and growth. And holiday restocking or genuine stabilization? The view from the outside looking in with Jingy Pan of S&P Global Market Intelligence in Singapore. Filipinos were unemployed in November compared to the previous month. The Philippine Statistics Authority has just announced the unemployment rate fell to 4.4% in November from 5% in October. This means about 2.25 million Filipinos were jobless during the month. The figure, however, is higher than the number of unemployed individuals in November 2024 at 1.66 million. Meanwhile, underemployment also fell to 10.4% from 12% in October, translating to around 5.1 million individuals. The country's employment rate stood at 95.6%, led by the services sector.
Ang services sector pa rin ang nananatiling bumubuo sa pinakamalaking bahagi ng labor force na may 62.1% share. Kasunod nito ang agriculture sector na may 20% share, habang ang industry sector naman ay may 17.9% share.
With us now for her immediate reaction, Consul Nina Manju, the immediate past president of PCCI and chairman emeritus of the Employers Confederation of the Philippines. Happy New Year, Consul Nina, and welcome back to the program.
Happy New Year and good morning, Cathy.
Okay, so what do you make of the November data on employment?
The figures that are presented actually are more or less the ones that are in the market. But we are expecting, or we're looking at improvement of our labor sector for the coming months of 2026 because of our newly approved budget, which is focused more on job creation, health, and education.
But let's talk about the December labor situation. Given how the Christmas shopping season turned out, how might have the employment picture turned out for last month?
Well, I think that is still the effect of the previous problems that we had on the second quarter of 2025. Is still sliding down to up to December. But it's looking better. It's looking better than the third quarter and up to about September last year. The December is better than the September, October, November figures.
All right, well, let's push forward then to January, February. We won't be getting the official figures, not in a couple of months, but from where you're standing. What's the likelihood, post-seasonality, often the results for the first quarter results in job losses because the temp workers go. What is ECOP bracing for, at worst, for January, February?
Okay, for the first quarter of the year, maybe you would still have a lower, higher unemployment rate, a little higher, but it will improve as we go on, spending and improving our infrastructure, constructions moving forward due to the budget approved recently. Although there is this fear of, because there is recently an announcement for the 750 national minimum wage, that might affect the employment capacity of our business sector.
Okay, let's take that in two parts because you're assigning a lot of confidence at a time we're seeing cuts in growth forecasts, not only for this year, but next year. Where's your confidence coming from that there could be an improvement in employment for the first quarter of this year?
Because our newly approved budget is more focused on job creation, and probably this will resume the construction and infrastructure development in our country. Because there was a slowdown during the issue of our corruption in the second quarter of 2025, which is being addressed by our government. And when they approve the budget, they're more focused on creating more jobs through infrastructure development, constructions, and everything. No? And we feel that with this move of our government, we will improve our employment capacity and employment rate.
But admittedly, the lingering governance issues, Nina, have turned businesses cautious for the most part of the latter part of last year. So
Yeah.
how much of the labor data by January, February, do you think will still be seasonal, as you mentioned earlier? And how much of it might already be structural in nature, the issues that we're facing in the employment situation, given the manifesting slower growing economy?
Well, probably on the January, February will still be like December. But on the second quarter, we feel or we're looking on an improving rate. It could probably bring down our unemployment rate by the second quarter. The business sector confidence is improving, as we all know, because of the reforms that are being implemented. I mean, our newly installed finance secretary had installed some reforms in our BIR, and I think they maintained the projection of 15% growth in the BIR collection, 15% of our GDP. So in doing that, in doing all those reforms, and by the government, business will improve, which goes to say that employment will also improve.
But there is that threat, as you mentioned, of the 750 peso wage hike that employers fear might trample on the potential gains. In what way, Nina? Because inflation right now is still at what the Bangko Sentral sees at lower than its target. So presumably there is a little bit more bandwidth for wages?
We just feel if we mandate a minimum wage of 750 all over for national, no? We feel that there are sectors that might not be able to handle the impact of this minimum wage uniformation. We still feel that if we recommend an increase in labor rate based on the capacity of regions and sectors, the impact is not so much. The SME, for example, they may not be able to absorb this 750 sudden increase in the minimum wage. There are still sectors on the MSMEs that are still struggling as a result of the previous problem on corruption, on the pandemic, and all these natural disasters that we had experienced.
All right, so which sectors then would be imperiled if indeed the 750 mandated wage hike would be implemented across the board?
we're looking on, well, the only bright part that we're looking at is the IT sectors. But the affected ones we feel are, for example, the ones into the manufacturing, the ones into food sectors, the one into, because we cannot just increase on prices on these sectors. It's going to affect our inflation. It's going to affect our if we increase prices due to the increase in labor, it might affect our inflation rate and growth. So if we do it gradually according to sectors that are moving forward and developing, we might be able to reduce the impact. Manufacturing will be greatly affected by this. Food sector will be greatly affected, and even our agriculture. Productivity will be less unless we start rescaling and scaling our manpower and improving the skills.
So just to recap, you're not for an across-the-board 750 mandated wage hike, but you are for a selective increase. If so, which industries then?
Probably the IT sectors, the I should say the ones into telecommunications, the ones that are into the higher hierarchy of the industry maybe can absorb. But the ones that are into the MSMEs, I think we have to really reevaluate that.
All right, then we'll leave it at that. Thank you so much for your views. Appreciate that. Consul Yunina Manju, the Chairman Emeritus of the Employers Confederation of the Philippines. And in other news, Malacanang has expressed reservations over a Senate proposal to cut the value-added tax from 12 to 10%. The palace said the proposal needs stronger justification before gaining support. Executive Secretary Ralph Recto said the government's debt position must be a key consideration in any move to lower taxes. This comes after Senator Erwin Tulfo proposed to bring the VAT back to 10% to help ease inflation. Tulfo filed Senate Bill 1552, citing that the Philippines imposes one of the highest VAT rates in Southeast Asia, along with Indonesia. Recto, however, warned that the country is already borrowing heavily, even with the current VAT rate in place.
Considering that we're still borrowing 1.6 trillion, that should be a factor in determining whether we should reduce it or not.
Recto, who served as the finance secretary and a lawmaker who pushed for several tax laws, including the measure that raised the VAT to 12%. He previously warned that cutting the VAT could strain government finances and risk a credit ratings downgrade. For his part, Finance Secretary Frederick Go said he has discussed the proposal with Senator Tulfo, but stressed that any VAT cut should come with a review of existing exemptions.
It should be coupled with removal of VAT exemptions. Because one of the reasons why we have a low VAT efficiency is because there are so many exemptions in our country for VAT. So you have to lower the VAT rate. Pwede naman, but you have to remove all the VAT exemptions. Also, if that means reduced revenue for the country, we should also correspondingly reduce the expenses.
You're watching Money Talks. Coming up, Jollibee food stock jumps after announcing plans to spin off its international business. And Jingyi Pan of S&P Global Market Intelligence joins us for a 2026 outlook. Keep it here on One News. back to Money Talks. I'm Cathy Yang. The Bangko Sentral ng Pilipinas says another rate cut could come as early as its first policy meeting in 2026. That's amid subdued inflation and dismal economic growth last year. When asked about the likelihood of a February cut, BSP Governor Eli Remolona said it is on the table. He cited the December inflation print as reasonably low and economic growth expected to miss targets. The Monetary Board ended 2025 with a fifth straight 25 basis point cut, bringing the key policy rate to its lowest in over 3 years at 4.5%. It has so far delivered a total of 200 basis points in cuts since it began the easing cycle in August 2024. Remolona said any further easing will be data dependent, adding that more than one additional cut would only be considered if growth falls below 5%. The Asian Development Bank says household consumption in the Philippines is expected to rebound in 2026. ADB Country Director Andrew Jeffries told Business World household spending, which accounts for over 70% of the economy, is expected to strengthen on the back of low inflation and accommodative monetary policy. He said policies should focus on raising incomes and reducing vulnerability, including expanding quality jobs, boosting productivity through skills and upgrading, and providing targeted social protection. This comes after private consumption growth slowed in the third quarter of 2025, with discretionary spending hit by weather-related disruptions. Data from the Philippine Statistics Authority showed household final consumption expenditures slowing in the third quarter compared to 2024. It also indicates spending grew at its lowest pace since 2021 and, excluding the pandemic, the weakest since 2010. The Federation of Philippine Industry says firms have cautiously resumed purchasing activity, anticipating future output growth. This as stronger domestic demand propped the Philippines Purchasing Managers Index in December, ending a 3-month decline in new orders. In December, PMI went back above the 50 threshold, separating expansion and contraction. It's an improvement from November, when it suffered its steepest drop since August 2021. With us now for more from Singapore is Jingyi Pan, Economics Associate Director, S&P Global Market Intelligence. A very happy New Year to you, Jingyi. Welcome back to the program.
Happy New Year, Kelly. Thanks for having me, and certainly some good news to bring here.
Indeed, and if you speak with the Federation of Philippine Industries, they're going to tell you that this isn't a fleeting lift from holiday restocking, but a signal of genuine stabilization. But what do you think?
Well, Kelly, I think it's certainly in November, well, relating last month when we talk about the November numbers, I think we've already expected some of this rebound, especially given the future output index itself shooting to the highest number seen so far this year, despite the PMI readings, the output readings, and also the headline readings sinking below 50 and showing that kind of steep downturn. We understand that that was largely due to the weather disruptions and some of the corruption scandal management. But to some extent right now, what we have seen in December is a recovery in the sense that it's reflecting the true situation in the Philippines manufacturing sector. We have new orders, as you mentioned, returning to expansion at one of the strongest numbers we have seen in 2025 as well. And that has driven, purchasing, as you mentioned, this Business Federation, they have reported it as well. So in the PMI, we see people starting to buy again, starting to stock up finished goods in anticipation of sales in 2026. And more than that, I think also on the employment side, there was some stabilization after what was one of the more steeper drops in 2025 in terms of the labor numbers. So this is telling us that in December, we're seeing a bit of a broad-based recovery. Certainly, I would say it's not really unique to the Philippines because we see in other Asian economies as well around the region, this kind of uplift has been seen. But certainly for the Philippines, it's a notable recovery given what happened in the prior months to December.
So
and I would say
broad-based recovery, notable in what you're saying, but output is still contracting.
Well, definitely. I think that's a good point to pick up on. We still have output in a reading below 50. But with that being said, that has also risen from November's reading. What we find as the key reason is really just at this point, perhaps new orders hasn't been enough to lift output into expansion again. But I won't be surprised as well that, some of, given the weather disruption, some of the operations in December haven't perhaps, resumed fully. So I think into January, we'll get a better picture of what's happening on the output side of things. But with demand, that's definitely the leading indicator. It is the one that we watch for the next few months output situation, and that number has rebounded. Future output, even though it slipped slightly from November, is still one of the strongest as well we have seen in 2025, reflecting the expectations among manufacturers for production to resume in 2026 in a positive manner. Certainly our forecasting economists, if I may, had also predicted a stronger growth for industrial production in 2026. So that's something that we definitely look forward to for the Philippines manufacturing sector.
And all that positivity is coming from a stronger domestic demand. That lifted December PMI. But how is domestic demand holding up beyond the holiday season?
Well, so our numbers are seasonally adjusted in the sense that this is not perhaps, showing what's happening because of holiday buying. This itself is showing a trend that is, compared to maybe December last year, if I could just use this as a layman example. So in other words, we are seeing the strong rebound happening already in December despite the holiday effect. What we are seeing going into 2026, well, certainly a lot of the domestic sources are still the ones that we're counting on for demand to come through. External demand is still weak, and I will say again, this is not something unique to the Philippines, as you see other Asian economies also reporting. In fact, global manufacturing reading for goods trade is actually still below 50. So that is something that we look forward to, well, perhaps a recovery in 2026, especially driven by potentially what could be the US. They stocked up a lot in 2025, front loading that's helped Asian economies to some extent. But in 2026, well, we do see the likelihood of, some of these stocks getting used up first, but into the latter half, that inventory rebuilding is expected again. So from that perspective, we are not perhaps, looking to the US being performing badly in 2026, and that could show up some of the demand as well for goods from our Asian economies, including the Philippines.
But really critical to sustaining growth in PMI are exports. That would be key in sustaining the momentum. How are you seeing now the export market conditions? Because they've been pretty dire over the past couple of months.
Definitely. I think 2025 has been one where we entered with expectations that the tariffs, perhaps will not be so bad. Obviously, in April, that hit hard. But certainly, the front-loading impact had actually helped to cushion the fall. And at this point, what we have seen into November, December is that we had a little bit more clarity, a little bit more relief with respect to the tariffs. So going into 2026, I think the expectation is more for the dust to settle. And from that perspective, exports, while still the key uncertainty for the market, hopefully is going to only go in the upward trajectory in terms of recovery. So that's our current expectation. And also, well, alongside some of the recovery in terms of tourism for the Philippines, better disbursement and reforms altogether, I think that's going to have the expectation of a stronger growth. Definitely still falling between the weaker target from the Philippines government, around 5 to 6%. So 5.4 is the number we are looking, but that's going to be stronger than the 4.8 we have penciled in for this for 2025. Harry.
Just very quickly, if you were to translate the PMI's forward-looking signals into policy advice, what's that going to be? One measure from the government.
Well, I think definitely to a large extent, it's really the expansion of the manufacturing base. From what we have been seeing, it's that a lot of the strong domestic demand come from, well, expectations for business expansion plans, growing of the customer bases. And I think these are the kind of things that the government could actually put effort behind to supporting to keep that momentum going on from what we have seen in December, and hopefully that really does materialize because we see there are plans to do that as well. So yeah, that's really part of our basis as well for the stronger 3.2% expectation for industrial production growth in 2026.
All right, so we'll leave it there with more questions and answers, but it's good to keep that optimism. Jingy Pan of S&P Global Market Intelligence live from Singapore. Let's take a look at the markets. Investors are looking beyond the geopolitical tensions with Venezuela and it's lifting the U.S. The Dow posting a new record yesterday, Tuesday, climbing up 1%. The blue chip index is off to its best start to a year since 2003. Both the S&P and the Nasdaq advanced by 0.6% each. The market data show that January has always been a good month for the stock market as investors rush to take positions for the year ahead. The benchmark, a 10-year Treasury yields ticked up to 4.178%, and gold prices rose to $4,482 per ounce. U.S. futures are moving marginally in after-hours trading, with the Dow, the S&P, and the Nasdaq all up by less than 0.1% each. Let's take a look at the Asian markets. They are looking mixed as we speak this Wednesday. Investors are parsing through Australia's inflation data. The benchmark ASX 200 rises by 0.3%, and South Korea's Kospi rises by 0.6. Japan's Nikkei 225, though, falls by 0.4%. Australia's CPI came in at 3.4% year-on-year in November, slower than the 3.8% in October. As for Philippine shares, they are in the red at the get-go. They rallied yesterday to a 5-month high, but all that has gone away for now, 6,309. The stock markets gained over 150 points yesterday, Tuesday, or by 2.5%, as investors gobbled up shares following inflation data that remained below the government's target. The broader all-shares index climbed nearly by 1%, with all the local counters in the green. Let's take a look at the Philippine peso. It has opened weaker, 59.24. That's about the weakest so far this year. Note that the local unit posted its worst finish on December 9th at 59.22 to the dollar. The peso closed yesterday a shade higher than its record low at 59.21 against the greenback, with geopolitical tensions weighing on sentiment. And the 10-year government bond yields have ticked down to 6.019% from the previous 6.058. In corporate news, Jollibee Foods Corporation has announced its plans to spin off its international operations and list a new company on a U.S. stock exchange by 2027. JFC announced a new strategy in yesterday's disclosure with the Philippine Stock Exchange, saying establishing two distinct businesses will, quote, sharpen strategic focus and enable investors to engage with the business profiles most aligned with their investment objectives. The company said its Philippine business will remain listed on the PSEI. The proposed Jollibee Foods Corp International will handle a portfolio of international concepts across geographies. Currently, JFC has 6,859 stores abroad, with units located in China, Europe, Middle East, Africa, Asia, and North America. As for its domestic operations, JFC will continue to focus on expanding stores for its 19 brands. JFC operates 3,445 establishments as of September 2025. Brands include Jollibee, Greenwich, Chowking, Red Ribbon, Mang Inasal, Burger King, and Coffee Bean and Tea Leaf. JFCI is wrapping up its spin-off process by late 2027. Juan Paulo Colet of China Bank Capital Corp says JFCI may turn out to be bigger than JFC, but there are risks associated in entering new markets. JFC stock surged yesterday's trading, up 14% to close at 210 pesos per share. It's now trading lower by over 1% at 207 pesos per share. That is it for Money Talks. I'm Cathy Yang. Catch us again tomorrow at 9:30 a.m. Kapatid, we are One News, all sides, all the time. Have a great day ahead.